the question was, how much equity am I looking to give up in order to get the investment that I'm looking for right now? As little as possible, which is what you're always looking to give up. Look, there's a fine balance between when's the right time to raise outside money and when's not, and it's a dance. Everybody, you as the entrepreneur, you want to wait as long as possible in order to raise money because you want to be able to get the highest possible valuation for your business, so you give up as little as possible. The investor wants to wait as long as possible also because they want to de-risk the investment, and they'll carry on your back as long as they possibly can. Kind of rule of thumb is that you're probably going to give up 25 to 30% of your company in your first round if it's of any reasonable size. You can do smaller rounds with friends and family or angel type investors that you might structure as a convertible note into your first round. And I don't know how much of these topics have been covered here, Doug, in terms of financing. You'd probably invite me back and we'll do a whole session on financing for you guys and what to look for. But you're going to typically give up 25 to 30% in your first equity round. What's more important to look for than actually the number, and by the way, one of the interesting things here is you're going to give that up no matter how much you ask for. So whether you're raising, I could probably get away with $750,000 to do what I want, but I know I'm going to have to give up that amount anyway, so I might as well get more. The reality is valuation is not a science. It's about control and leverage and what the investor is looking for. They're going to want, for your first round, especially in your first company, they're going to want to control you and own you. They'll ask for 50%, but you'll get to 25 to 30% if you negotiate it. Well, but then what they're going to be after, what you have to watch out for are the terms of the investment. And those terms are going to give them almost always in the first pass, basically they own you. And they're going to decide whether or not you can sell the company and how much you can sell the company for. And they're going to stack the board of directors in their favor. And they're going to have control over any follow-on financing and who you can take it from and what terms you can take it from. But you need the money in order to run the business, but if I were watching out for it, I'd watch out for the terms. That's almost more important than the equity. Nothing is worse than, and I have been here in Narrative in the first company. The first investment we put in was just under $2 million. Within 4 months, we had an offer from a public company to acquire the business for $25 million. I wanted nothing more than to take that money, and even though I still had a majority control of the shares, actual shares of the company, I had given up stupidly in the rights to the investors, the right to veto an acquisition like that, and they blocked that acquisition. And I eventually sold the company 4 years later for more than $100 million, but what I got out of it personally was less than what I would have had I taken that initial deal after 4 months. So terms are more important than actual equity ownership.